Hello and welcome to Wealth Management Insights. I'm Monica Guerra, Head of U.S. Policy for Morgan Stanley Wealth Management, and I'm joined today by Daniel Kohen, U.S. Policy Strategist in the Global Investment Office. We're recording this audiocast on Monday, July 14th from Purchase, New York. Today we're diving into the recent tax reconciliation bill known as the One Big Beautiful Bill Act, or OBBBA. It's a significant piece of legislation that has far-reaching implications for investors, markets, and the broader economy. So let's start by setting the stage here. The GOP's top agenda item, the tax reconciliation bill, has finally passed. This moment introduces increased economic and policy certainty for investors, despite tariff and geopolitical overhangs. So Daniel, what do we need to know about this?
Thanks, Monica. Even though we still have some uncertainties, the known knowns have increased, and the OBBBA is an example of this. We can break the bill's primary provisions into 4 parts. First, it makes most of the individual and corporate tax cuts from the Tax Cuts and Jobs Act permanent. Second, it introduces new individual and business tax cuts, including President Trump's no-tax agenda. It also raises revenue, mainly by tightening Medicaid and SNAP, and phasing out certain clean energy tax credits. And finally, it increases the debt limit by $5 trillion. Now, that's a lot to unpack.
Yeah, it sure is. And it's estimated to add $3.3 trillion to the federal deficit over the next decade, which could push the deficit above 7% of GDP by 2026. Importantly, the tax cuts are front-loaded, while the spending cuts are back-loaded. So the biggest fiscal stimulus, almost 1% of GDP, is set to hit in fiscal year 2026. That could have some serious implications for markets and the economy.
Definitely. And since we are talking deficit, let's discuss the impact of the bill on interest rates. With greater deficit spending, we could see upward pressure on term premiums at a time when 1 in 5 federal tax dollars goes just to paying off interest. On the other hand, our Global Investment Office fixed income team notes that the all-in deficit impact was perhaps not very surprising for the bond market, given that term premiums have been rising since the beginning of the year. So, Monica, is it worth considering tariff revenue here?
Yeah, that's a good point, and I think so. If kept at current levels, which is a big if, tariffs could raise over $2.6 trillion in revenue over the next 10 years and substantially offset the cost of the bill. Regardless, though, we're likely to continue facing a higher for longer interest rate environment, which is something investors need to keep in mind, especially in the fixed income markets. Now, if we dig a little bit deeper into fixed income, we should touch on the $900 billion in Medicaid spending cuts. The changes of the program could shift healthcare costs from the federal government to localities, potentially pressuring the credit quality of certain state and nonprofit hospital municipal bonds. This is a development that municipal bond investors should keep a close eye on. But shifting gears, Daniel, can you tell us what investors should be tracking in equity markets?
On the corporate side, the revival of various business tax provisions could lower the effective corporate tax rate to as low as 12%, down from the statutory rate of 21% today. That might incentivize corporate investment, boost growth, benefiting domestic industrials, communications, and energy infrastructure stocks.
Yeah, and speaking of energy, throughout the year, clean energy stocks were pricing in swift and deep phase-outs to the Inflation Reduction Act tax credits. While some areas were directly impacted, like electric vehicles, the final law was more modest relative to our initial expectations, and areas like nuclear, hydrogen, and geothermal received carve-outs.
Absolutely, and that's important because the softer approach to clean energy is partly why it's outperformed the broader market by about 12% this year.
Wow, that's a really great point and a great way to remind investors that the relationship between policy and markets is nuanced and takes careful consideration. But like all good things, this needs to come to an end, and I want to thank you all for listening. For a more in-depth discussion at the intersection of policy, markets, and the economy, please ask your Morgan Stanley financial advisor for copies of our most recent U.S. Policy Pulse report.